There are two dreaded words for passive real estate investors: capital call. Does a capital call mean that the deal is going sideways? If you don't invest more capital, will you see the same return? On today's episode, we are going to debunk capital calls and why you might not need to panic if one occurs in a deal you've invested in. Hello, Pocketeers. Welcome to Passive Pockets, the passive real estate investing show. I'm your host, Jim Pfeiffer. On today's show, we're bringing on one of the most respected operators and investors in the passive investing space, Brian Burke. On today's episode, we are going to talk about what is a capital call, why do they occur, how can you be prepared if it happens to you, and what GPs should be doing and how they should communicate with LPs if a capital call is necessary. Let's bring on Brian. Brian, thanks for coming on the show.
Thanks for having me again.
We're excited to dive back in, and it is not necessarily everybody's favorite topic, but we're going to talk capital calls today. So can you start out, just explain to us what is a capital call and why might it be necessary in a syndication?
A capital call is when a sponsor of a syndication asks the investors in that syndication for money. Now, there's two kinds of capital calls. There's a planned capital call, like in a fund. You commit $100,000 to a fund, and they make their first acquisition, and it's time for them to ask you for $10,000 to fund part of your commitment. That's normal. It happens all the time in funds. I think what we're really focusing on more today is going to be unplanned capital calls. And an unplanned capital call is, let's say you committed $100,000 to a fund or a single asset syndication, and for some reason you've sent in your whole $100,000, but now for some reason the sponsor's asking you for additional money that goes above and beyond the $100,000 that you agreed to commit and had already funded. That's what a capital call really boils down to.
Yeah, and that's the kind that people generally are not happy to hear about. So how often do capital calls typically occur in a normal market? We've gone through kind of an abnormal or distressed market the last few years, but how often do they happen in a normal market? And then I assume they happen much more often in the kind of market we've had recently.
Yeah, in a normal market, they don't happen very often. The cases where you might see a capital call in a typical market is ones where, let's say the sponsor maybe made an error in calculating how much capital they were going to need, and they didn't raise enough money for their capital improvement budget, and they started fixing up units and found out they were short and they needed more money to finish fixing up the units. That'd be one example of a capital call in a normal market. Another one might be something happened, right? Like a hurricane came through and it tore off all the roofs, and the insurance company would only fund some of the repairs, and the group has to fund the rest of the repairs. That might be an example of a capital call in a normal market. And those things happen from time to time, but pretty rarely. I can say that in the 23 years I've been doing this, knock on wood, I've never issued an unplanned capital call. I'd like to say that I never will, but you can never say never. Now, in a market like this, we're recording this in the middle of 2024. We've just come through a really sharp downturn in the commercial real estate space that's affected multifamily and office both pretty heavily. Cash flows are compromised in some cases due to high interest rates. Hold times have to be extended to wait for values to come back. In a market like that, capital calls become much more common because there's other issues you have to solve, like running out of money, needing to get a refinance, having to put capital improvements into the property that you didn't think you'd have to do because now you have to own it for longer. That list goes on, and capital calls have become, unfortunately, quite frequent here as of late.
They have been. We've seen a lot of capital calls recently, and we all understand that interest rates increased very quickly, right? And that was a big issue. Is that the main cause of all these capital calls? If that didn't happen, would we not have had these capital calls? Can you talk about, are there other reasons besides just the rate of the interest rate increase?
I'd say the interest rates certainly play a role, and probably a large role, in the reason for all of the capital calls that we're seeing. And so it sparked a couple of things. The increased interest rates have caused debt service to increase for borrowers that have floating rate loans. And even borrowers that have fixed rate loans aren't immune from interest rate movement if that fixed rate loan matured recently and they found themselves having to refinance into a new loan at a much higher rate. In those cases, that higher debt service cost is eating into sponsors' reserves if they had any at all, and they might be issuing capital calls to bulk those reserves back up or to fund future negative cash flow from interest rate movement. The other way that it's been impactful is that those who have floating rate loans in most cases will have an interest rate cap, which is a derivative that the sponsor purchases that locks essentially a ceiling onto the interest rate. But that comes at a price, and it also is a limited life, and you have to renew that interest rate cap, and doing so is very costly. And as interest rates go up, the price of those caps has gone up dramatically, and that's meant that some sponsors have had to issue capital calls to cover the cost of that interest rate cap replacement. But the other thing interest rates have done is they've just basically forced cap rates down, so values have declined, which has made refinancing difficult. So that's caused some capital calls because you need to do a cash-in refinance. And then, finally, we've got like a lack of rent growth or negative rent growth. And the negative rent growth has been compromising cash flow as well and creating kind of the similar situation. Oh, and by the way, at the same time, expenses have gone up thanks to inflation and skyrocketing insurance rates. And that also could be eating into cash flow. So really, there's a confluence of factors that have all kind of come together at the same time.
Yeah, and a lot of people blame bridge debt, right? That's the main problem here. And you have given in the past just a great explanation of the difference between bridge debt, adjustable agency debt, and fixed agency debt, and the use cases for each and why someone might use one or the other. So can you go through that for us?
The safest loan product available is a 30-year fully amortizing fixed rate mortgage. And that's what you probably have on the home that you own. And in that case, you'll just pay the same monthly payment every month until the loan is paid off. Unfortunately, that product does not exist in the commercial real estate space. Commercial real estate loans are usually 5, 7, or 10 years, and then there's a bridge product that's 3 years. So given that, you have to make a choice of what kind of loan you want. And so a 10-year fixed rate loan, for example, same thing with 5 and 7, the interest is fixed, but you can't pay the loan off early without an enormous prepayment penalty. And so to avoid a prepayment penalty, some real estate owners use floating rate debt because it takes away that prepayment penalty risk, but introduces interest rate movement risk. And we've seen that as an issue here lately, where that interest rate movement has compromised cash flow. And then there's the bridge product. The bridge product is really intended for properties that are underperforming. They don't qualify for agency debt, maybe because they don't have 90% occupancy for the last 90 days. That's one key requirement for agency debt. So they have this loan product that's essentially a floating rate 3-year bridge product that's not really tied so much to the property's cash flow. They use different tests to determine the sizing of those loans. And they're really designed to bridge you from the underperforming property to a fully performing property where you would then refinance and take out the bridge loan. What we've seen happen more recently is sponsors have basically repurposed the bridge loan from its original intent to become one that basically bridges their shortcomings, which is they can't raise enough capital, so they use the bridge loan because it has a higher loan to value ratio and therefore they raise less equity. That's one case where I've seen it. Or another is they can't raise enough capital without having a really large projected return. And the way they engineer themselves into a high projected return is to use high amount of leverage, and only a bridge loan will do that. And those loans, with that 3-year maturity, if that due date comes up in the middle of a market downturn, you've got a really difficult problem to solve with almost no exit. And, that's contributed to some of the capital calls that we're seeing out there.
We do have to take a break, but more on capital calls when we return. Welcome back to the show, Pocketeers. We are here with Brian Burke. Let's jump back in. We're in the middle of September 2024, and they just decreased rates for the first time, the Fed. So how is that going to affect the rate caps on current adjustable rate mortgages?
Eventually will affect it to some degree. Right now, most floating rate loans are above their rate cap strike price. So let's kind of break all this down and how this all works. Let's say you're going to get a floating rate agency loan. They're going to tie the interest rate to a loan index called SOFR, which is the Secured Overnight Financing Rate. It replaced the old LIBOR that used to be a common index for floating rate loans. And they're going to add a margin onto that. Like let's say it's 1.5%. So 3 years ago, when you took out a floating rate loan and SOFR was 0.05% and your spread was 1.5, that meant that your all-in interest rate was 1.55. It's really, really low. Now you fast forward to now, SOFR has jumped to 5.3. So, now you're at 6.35. So you can see how much the rate went up. Well, somewhere in that process, the lender is going to underwrite a strike rate for a cap. And they're going to say, okay, if the index rate reaches 3%, anything above that would throw your property into negative cash flow based upon our underwriting at the time that they're making the loan. So we want to cap the rate at 3%, so you're always above a 1.0 debt service coverage ratio, meaning you always have as much or more income than you do debt payments. And they'll make you buy a derivative called a rate cap, which will pay you if the rate exceeds that strike rate. Using my previous loan as an example, if your spread was 1.5 and the strike is 3%, your interest rate is effectively capped at 4.5. And as long as the rate is below 4.5, the sponsor's absorbing all of that difference. But if the rate goes to 5, for example, that extra 0.5%, the derivative holder will pay you that 0.5% interest to essentially reimburse you for that surplus interest cost. That may seem great, but they're only doing that in exchange for a fee. And when you have to replace that cap, they're going to analyze their risk and determine how much they want to charge you for that cap based on that fee. So kind of going back to your question about will the lowering rates affect sponsors' cash flow? Not so much if your rate is, let's say, 2% higher than your cap strike. That rate has to come down 2% before you'll feel a thing. Your cap derivative counterparty will get a big discount. They won't be paying you as much, but your net effective cash flow is going to remain the same until it drops below the cap strike.
I think people look at the interest rate decrease, both some operators and investors, and it's the thing that's going to solve everything. Now we're back to easy street. We're back to the late 2019s when everyone was making money hand over fist and there were no problems, right? The distributions are going to start up again. Deals are going to start going full cycle again. We're going to start doubling our money every 2 to 3 years. Can you talk to that? Is that how you see it? I doubt that you do, but what's the impact going to be of this decrease?
Well, if you're a real estate sponsor, offering syndications, you want to believe that to be true. And I am one, but I don't believe it to be true. If you're a limited partner invested in a real estate syndication, you want to believe that to be true. So it's a great talking point to say, like, yes, this is going to solve everything. But the reality is it's not going to solve everything. It's going to certainly help. It's going to help syndications that have compromised cash flow due to rate cap replacement requirements impacting their cash flow because they have to save up the money for the rate cap. Their rate cap replacement is going to get much cheaper thanks to the lower interest rates. That's going to help their cash flow situation out for sure. Is it going to solve everybody's problem and we're going back to 2020? Or 2021 when things were like firing on all cylinders? Absolutely not. There's other factors at play. We still lack rent growth. We still have comparatively high interest rates. We still have higher expenses and more expensive insurance. None of that has changed. So it's certainly going to make a difference, but it's not going to solve all problems.
Okay, and you mentioned the rate cap replacement. So can you give listeners a little bit of an idea of what exactly that means. How often do you have to or get to replace your rate cap when you buy one and rates go up or they go down? Can you cancel that one and buy a new one? Just kind of talk the basics of the rate caps and how they get replaced.
Yeah, this is a bit of a minefield because it's a little all over the place. Some of the bridge loans that came out, they did a 3-year rate cap, and it was a 3-year loan, and there was no provision whatsoever made for replacing the rate cap because the lender's assumption was, you have to pay us off in 3 years. We don't have to worry about you replacing the 3-year rate cap. Well, now, lo and behold, the 3-year comes up. There's no way to pay the loan off because the property isn't worth enough. They can't sell it. They can't refinance. And they didn't save up any money for a new rate cap. And the rate cap is expensive now. The rate cap that might have cost them $20,000 when they took out the loan is now like $500,000. And they don't have any money saved up. So that's been a big issue. Now, on an agency loan, for example, they'll require rate cap replacements, and they'll require you to set aside money to pay for that rate cap replacement. Most lenders will evaluate twice a year the projected cost of a rate cap, figure out how much you have saved up for it, and determine whether or not you're on an adequate track. And if they feel like you're going to be underfunded when the cap comes due, then they're going to increase the amount you're required to put on deposit each month to save up for that rate cap replacement. Now, most initial rate caps are for 3 years, and then when you do a replacement, your lender is going to tell you how long. Generally, it's a 1-year requirement, but you can buy 1, 2, 3, however long you want. The longer the rate cap duration, the more it's going to cost, not only because of the added interest rate or interest that they might have to pay on your behalf, but also because the risk goes up, right? So, a 2-year rate cap is more expensive than twice the amount of a 1-year rate cap, if that makes sense, because there's added risk. I prefer to do a 2-year rate cap anyway because I want to transfer that risk to somebody else and lock my cost in for 2 years. So that's what I've been doing. I have 2 rate caps I've renewed on 2-year cycles, so I don't have to worry about them for 2 more years. So it just really depends on your lender's requirements, really.
Okay, so we've gotten kind of into the weeds on rate caps, and I appreciate that because it's all really good information. I want to kind of go back to capital calls, or how do we move forward from here also? So you hear people talking about bridge debt and how it's the big problem, and I'm never going to do bridge debt again, or I'm never going to invest in a deal with bridge debt again. So how do you see bridge debt moving forward, and what kind of debt do you think will be most prevalent now that rates are decreasing and maybe hopefully stabilizing at a little bit lower rate?
I stopped using bridge debt, I don't even know how many years ago. It's been a long time since I've done a bridge debt deal. Well, it's actually been a long time since I bought anything. I haven't bought anything in 3 years because I don't like the market. But even before that, for several years, I wouldn't do bridge debt. It's extraordinarily risky. Unfortunately, a lot of properties were purchased on bridge debt. I strongly prefer agency debt. I really like the agency floating rate product because you don't have yield maintenance to worry about, but I'm also seriously considering doing some deals on fixed rate, even though rates are a little high right now. It's a consideration. I mean, we have to, especially when right now floating rates are actually higher than fixed rates, thanks to the high SOFR rate right now. So I think what's going to shake out over the next, year or two, you're going to see fixed agency and floating agency become more popular. But you know how it is, Jim. Some people, they just don't learn. They're going to go back out and they're going to use bridge debt again and just figure that was an anomaly. Now, in part, they may be right. I mean, the most riskiest time to use bridge debt is at the peak of a market. In a trough of a market, there's a little bit less risk because you don't have as much downside risk. So that bet may pay off. I like a trade-off. If the property doesn't qualify for agency debt, then you can still use bridge debt but refuse the higher leverage and take one that's 60% LTV, for example, so that you have a margin of equity in there to protect your downside if the market continues to move against you. There are ways to defend yourself and still use the best financing vehicles out there.
I think we kind of took a detour to debt, and it was great. So I appreciate that. Back to the capital calls. As a GP, as an operator, how do you communicate when a capital call is necessary? Do you give your investors a heads up? How much information do you give them? How do you manage their expectations and not create a panic?
Well, I'll tell you what I do, and then we can debate what other sponsors do. Investor relations is a process of keeping your investors informed about everything that's going on, right, wrong, or indifferent, good or bad. The investors should know what's going on. Nobody should be surprised by anything unless they're not reading their reports. For me, if I was to do a capital call, I would be telling my investors the first moment I think it might even be possible that, hey, this might be coming. I sold about 3/4 of my portfolio right before the market crashed, but I still have about 1,000 units. And, the interest rates and rate caps have been impactful to ours, just like they have to everyone else's. And I can see that it's eating our reserves. And I put out a notice to our investors months ago that there's a possibility that a capital call could be in the cards for us. Even though we've never done one in 20 something years, it could be possible. And here's what you should think about. Here's kind of the timing that it could happen. Here's about how big it could be. Just be ready for it. We don't know if it's really going to happen. And to this day, I still don't know for sure if we're going to have to do one. I think we might actually avoid it, but I don't know for sure. But I think investors should know that. No investor should ever be surprised by a capital call notice coming out of the blue. Now, other sponsors, I've heard things all across the board. I've had investors contact me and say, I was just blindsided with a capital call notice from sponsor XYZ. What should I do? And it's like, you should never be in that position. You should have known long before that notice came.
Yeah, and I can vouch for that because I am an investor in your deal, and you, in fact, did send out a report, and it says, capital call might be coming down the road 12 to 18 months from now. And a couple days later, I got another capital call from a different operator who had just sent out their quarterly report like the week before that said, everything's looking great. And then a week later, I get an email that says, everything's looking great, but we're having a capital call and we need your money next week. So there is definitely a difference in the spectrum of how people handle it. And as you said, no surprises. Like, first thing, don't lose my money. But second thing, no surprises. So I appreciate the way that you're looking at it. And that's part of the thing that people have to do is when they qualify as sponsors to make sure to ask those questions, right? And figure out how is the operator going to treat us like you do or like others do. So I do appreciate that. And that transitions into, as an LP, because I know you're also an LP investor, how do you react to a capital call? What information do you ask for? And how do you determine if you're going to participate or not?
Yeah, well, just to tie back to something you said a second ago, everybody has a different definition of everything is going great, apparently.
Apparently.
Because, I don't think that's really going great if all of a sudden a week later you need a capital call. And I've heard of another one where they issued a capital call notice and then subsequently canceled the capital call notice, and then weeks later the property was foreclosed. So to answer your question about how you react to a capital call, you have to look at this pragmatically. I mean, this request for capital from you should be evaluated as if you're being asked to make a new investment. And you want to know if you're going to get a return on the investment that you're about to make. And this is a very complicated analysis compared to just a brand new acquisition. So think of it this way first. One question I would have is regarding the initial investment that I made, where does that investment stand? If we were to liquidate the property today, would I be 100% wiped out? And of course, the answer that you don't want to hear is yes, you'd be completely wiped out. However, if that is the answer, that makes your decision a lot easier, actually. Because if let's say, for example, you put up $100,000 and they're asking you for 20 more, and they can show you a very clear path to, if we get this extra 20 grand from everybody, we're going to be able to salvage this deal because here's what we're going to do. We're going to do steps 1, 2, 3, and 4. And here's the numbers and here's the plan. Here's everything. And the plan looks very reasonable. That could happen. And you're going to get no profit on your original 100 grand, but you'll get your 100 grand back. Well, now you can look at your 20,000 like, okay, I put up 20 and I get 120 back in 3 years. That's a damn good rate of return, right? So you would do that investment all day long. and that might salvage your principal. Now, if it's like, well, we don't know, or the plan is terrible, or it doesn't seem like they can really execute it, then maybe not so much. Where this gets a little bit more challenging is if there's a partial return of capital. Let's say, well, if we sold now, you get half your capital back. Now you have to determine, okay, if I got half my capital back now, what could I earn on that half that I have left in the time it would have taken to salvage this deal to get the other half? Could I make that on a different deal? And that might actually be a better path. Other situations where, let's say the property's, it's performing okay, and the reason for the capital call is we have to hold it an additional 5 years. And because of that, we're going to have to put on a new roof. And we were thinking we would have this property in and out in 3 years, wouldn't need a roof. We didn't budget for a roof. Now we need a roof, so we need an extra $1 million to put this roof on 20 buildings. That's a bit of a different story. In that case, you're talking, asset preservation. It's not as much about the return on the investment as it is just maintaining the property that you have so that you can, in fact, get a fair return on that investment later. So you really need to think about the money you're putting in as if you're making a new investment and make sure you're getting some kind of return on it.
We do have to take one final break, but while we're away, make sure to hit that follow button on your favorite podcast app so you never miss an episode. Welcome back to Passive Pockets. How do you figure out what questions to ask? Because a lot of times the operators aren't really giving full information. As we talked about, they're pushing the decision, way down the road, hoping it doesn't happen. And so then it might be the thing where it's, hey, we need the money in a week or a month or whatever. So what kind of questions should you ask before you determine if you're going to participate?
I would want to know, what's the property worth today? What did we buy the property for, and how much do we have into it? What's our loan amount? So you can calculate your loan to value ratio based upon present value. And the reason that I ask about, thinking about what you paid for the property is, if you don't know the present value, you can get some idea of your loan to value by knowing your going in LTV. Like, let's say when you went in, your going in LTV was 80%. And now you say, well, the market's fallen 40%. So now we're 20% underwater. That's an answer you're going to want to know. Versus, our going in loan to value ratio was 60% and the market fell 40%. That means the property's worth the loan amount. You're not underwater. There's a chance here. So that's kind of the first thing you want to know is that loan to value and valuation. The next thing I want to know is, when does the loan mature? Because I want to know when the sponsor is going to be forced to do something. And that something is going to be, they're either going to have to sell or they're going to have to refinance. If there's a maturity in the next 2 years, I'm going to be really nervous. If the maturity happened already and they're saying okay, we want this capital call because that's going to buy us a 1-year extension, then the question is, well, what happens in 1 year? You're still not going to be able to refinance, probably not going to be able to sell. The market isn't going to come out of this lull that quickly. So then what's the plan? We're right back into the same situation again. So you want to know there's enough runway for that thing to last. Going back to the example of the deals that you're in with me, I've got 7 years left on those loans. No one can force a sale for 7 years. The market will be much better in 7 years than it is now. So that's a different situation than, our loan matures this month and we need a capital call to get a 1-year extension with no plan to get past that. So those to me are the biggest things, is loan to value ratio and maturity date. That's the first thing I want to know.
Okay. And then when the capital call happens, there's an infusion of capital. If an LP decides not to participate in the capital call, what does this do to their share and their potential return?
If the sponsor raises money from other places, they can get diluted. Now, there's ways that the sponsor can raise capital without diluting the investors, but it still affects the investors. So they could borrow the money, which would come with interest expense, which they may not have the cash flow to service. They could get preferred equity, which is equity that gets squeezed in higher priority than you as a common investor. It doesn't dilute your percentage of ownership because they don't get a back-end profit split, but they do get current cash flow. and that current cash flow could have otherwise gone to you as an investor. So it will impact your return negatively. The other thing they could do is they could raise new capital from new investors, which dilutes you, but it may or may not cost them additional current cash flow, but it will dilute your interest. So if you participate in a call, you can maintain your interest if you're investing at the same percentage as your ownership percentage as a total of the whole capital call, or you can just accept the dilution.
This is another good reason to read the operating agreement and the private placement memorandum. Some operating agreements or PPMs have the capital call as mandatory, and some put it as optional. And I think we were having a conversation earlier, and you had said, what's the difference? Because even if it's mandatory, they can't force you to contribute. Can you talk a little bit about that, the wording, and what the obligation of the LP is?
Yeah, it's really important to read these operating agreements, and it's important to read them before you make your investment so you understand what you're getting into. But, that water may be under the bridge now as we're talking about this stuff nowadays. But mandatory capital call provisions are customary for a fund, for example, where you make a $100,000 commitment. You could be required to contribute your entire $100,000, and there can be penalties against you if you fail to do so. Now, some sponsors have adapted those types of provisions for unplanned capital calls, where if you don't fulfill an unplanned capital call, there can be financial penalties for you for failure to do so, which could include forfeiture of some of your original investment principal. Now, if that's already gone, well, then that's water under the bridge anyway. But assuming that you still have some equity left in there, there could be provisions in there that could be harmful to your principal in some operating agreements. Now, others, they do not have mandatory capital call provisions. These are far preferable from an investor standpoint, where these capital call provisions are voluntary. However, not participating in the capital call will have consequences for everyone. Either you'll get diluted, or preferred equity could be squeezed in at a higher priority than you, or the property could just end up getting foreclosed and lost because they weren't able to raise the capital from anyone and they just had to let it go. So there are repercussions from not participating, just in a different way. As
a GP, how does a GP handle it when not all of the LPs are participating? I guess they go and get preferred equity, or do they ask the LPs that are participating to participate more? How would they handle that typically? There's
a couple ways. The sponsor could anticipate that some investors aren't going to participate and ask for a larger capital call than they actually need and hope that they get what they really need. That's one way they could do it. Another way is that if there's a shortfall, they could get that money from other sources, whether that's preferred equity or raising money from new investors to make up the difference, and therefore diluting everyone. Even the people that fulfilled the capital call would get diluted to some extent, to a lesser extent than if no one participated, but certainly they would get diluted if they did that.
These investments for LPs, they're out of your control. They're long-term in nature. They're very illiquid. What, if anything, can an LP do when a deal they invested in is in trouble? Do they just sit around and wait for someone to call capital and then decide, yes, no, is there anything else they can do?
Not a lot, unfortunately. You're a real estate owner just like as if you bought the property yourself, right? So think about if you owned this property yourself, you were the only investor, what could you do? The only thing you can do is feed it with more money, sell it and take a loss, refinance if there's equity and cash flow to do so. Those are really your only options. The LPs don't have a lot of ability to jump in and take control in most cases. There are provisions in some joint venture equity agreements where like an institutional larger investor who supplied a really large check as a big portion of the capital might have control rights where they could step in and start making some operational decisions. But generally in most retail syndications, investors don't have the power to capture any control rights. They may have the ability to call for a vote amongst the members and basically vote the GP out and substitute in a new GP to take over. Doing so is littered with landmines and extraordinarily problematic, but might be a solution for groups that have just an egregiously bad sponsor or maybe an unscrupulous or criminal sponsor, exercise some type of kick-out provision if it's allowed under the terms of the agreement, might actually make sense.
Yeah, and again, that's a great reason to read the operating agreement and all the other documents. I have one more question for you, and in my mind as an LP, before 2021, I would always ask an operator, have you ever had a capital call? The answer was always no. Now, when I'm evaluating an operator, I'm going to get very different answers. I'm going to get a lot more yeses. And my thought is, now I'm asking not to know if you had one, yes or no, but if you had one, how did you handle it? How did you get through it? And so I guess my question is, as you are also an LP, how are you going to handle operators that have had capital calls, and what questions are you going to ask them to decide if you're going to invest with them? Because I don't think a capital call is disqualifying anymore as it was a few years ago.
Yeah, I would want to know the reasons for the capital call and how they announced it and how they handled it and what the outcome was after they had issued it. And I don't mean necessarily how many investors fulfilled it, but did they successfully execute a rescue plan that bailed out the investment and, produce some kind of tangible result? Or did they just simply lose more of the investors' money? How they got into the situation that required the capital call, to me, is really important. And it's that mistake, whatever it was, being repeated in this investment. For example, if the investment where they had a capital call was financed with high leverage bridge debt with a short-term maturity at the peak of the market, are we at the peak of the market now? And are you buying this with high leverage bridge debt, or did you learn your lesson? And, now we're buying at a better time in the market, and now you're using lower leverage financing, and now you're raising additional cash reserves. I've long said that LPs looking to invest with a sponsor really want to look for someone who's been through an adverse market cycle, survived an adverse market cycle, and navigated all those challenges, because there's no time where anyone learns more lessons than when things are going wrong. If the sponsor gets through this, capital call or not, and they survive and they produce a tangible result for their investors, that's kind of their path of growth that I want to see them go through. And if they applied those lessons to their future investments, they're probably a better sponsor now than they were before they issued the capital call.
Great answer. I totally agree with that. Brian, I really want to thank you for coming on the show. This was super informational. And I also want to say that, you have always been a great supporter of left field investors, and I'm so thrilled that now that we're Passive Pockets, that you were jumping on early and you are on the show and have come to support us again. So thank you so much for being on today.
Yeah, I appreciate it. I'm proud to be a small participant with Passive Pockets and the journey that is being undertaken right now. I think this is a really exciting thing for left field investors. It's a very exciting thing for Passive Pockets. It's really exciting for Bigger Pockets, and that means it's exciting for me. So thank you for having me here as a part of it.
Excellent. Thank you.